There are no easy outs to restoring price stability.
In its October monetary policy report, the Bank of Canada gives its outlook for the Canadian economy. The pace of growth, it says, is stalling. GDP, or economic output, is expected to pull back, and inflation is really holding back spending. To try and get inflation under control, the bank is again increasing its key interest rate. It's going up from 3.25% to 3.75%. The interest rate stood at just 0.25% at the beginning of 2022. But what does it mean to increase the interest rate? How will the Bank of Canada's changes affect your wallet? Canada sets its key interest rate as the so-called overnight rate, which regulates the rate at which banks borrow from the central bank. The average person, though, borrows against what's called the prime rate, which sits about 2% above the key interest rate at the moment. It's at 5.95%. The bank is increasing interest rates to try and get a hold on inflation. Currently, the consumer price index is out of control. It's sitting at a much higher rate than the bank's ideal 2 to 3% target. Increasing rates has a cooling effect on the economy, intended to bring down inflation. Less borrowing and less purchases lead to slower prices to meet lower demand, thus creating the overall effect of lowering inflation. The secondary effect is increasing rates for saving and investment certificates as they rise to meet the standard set by the Bank of Canada. Still, Toronto is the most expensive city in Canada in which to live, and the higher rates won't make it any easier. Mortgages, lines of credit, and other loans will cost more. And if you own a small business, expect less sales and more expenses. If rates are set too high, it might cause the overall economy to fall into recession or economic contraction. The Bank of Canada is signaling that more rate hikes are to come, but are predicting that by 2024, inflation should return to normal levels.